All right, let's jump right in. Have you ever just sat there wondering what really separates the traders who make it from, well, everyone else? I'll give you a hint. It's not some magic indicator. It's a deep, professional understanding of risk. Today, we're going to tear that apart and show you how to turn the market's traps into your biggest opportunities.
So, let's start with a number that's kind of hard to look at, but we have to. 90%. All the data points to this staggering reality. 9 out of 10 traders lose money. That's not just a scary statistic, it's the game we're playing. And figuring out why that number is so high is your first step to making sure you're in the other 10%.
And this quote right here just nails it. The road to winning doesn't start with chasing those huge, life-changing trades. Nope, it starts with an absolute obsession with not losing. The pros, the 10%, they know that protecting their capital isn't just a boring rule, it's everything. It's the foundation their entire career is built on.
So where does it all go wrong for most people? Well, it often boils down to not seeing what the market is really doing. You know those wild, frustrating price spikes that seem to come out of nowhere and stop you out? They're not random, not at all. They're incredibly purposeful, and they're designed to do one thing: hunt for liquidity. Okay, so what even is liquidity? Let's make it simple. Think of it as the market's fuel. It's these giant pools of orders, mostly stop-loss orders, that pile up at the super obvious spots on the chart. You know, right below that perfect support level or just above that clean resistance. The big players, the smart money, they need all those orders to fill their own gigantic positions. And believe me, they are masters at pushing price around just to go grab that fuel. So let's walk through this classic trap, the stop hunt. First, you've got tons of traders doing exactly what they were taught, placing their stops at a safe, obvious level. Then, bam, you get that nasty, aggressive price sweep that just demolishes that level, triggering every single one of those stops. This forces a wave of selling, which the smart money is just waiting there to buy up. And then, just as fast as it dropped, price rips back up, leaving everyone who just got stopped out in the dust, watching the trade go exactly where they thought it would. That's not a bug in the system, my friend. That's a feature. Yeah, this quote is intense, but it's the absolute truth of the market. For one of those perfect sniper entry trades to even exist, somebody else's trade plan has to completely fall apart. These liquidity sweeps, these stop hunts, they are the very mechanism that traps one side of the market, which then fuels the big move in the other direction. You just have to accept this as part of the game.
Okay, so we've identified the trap. Now what? Let's talk about the first part of the solution. This is a huge mindset shift, and it's all about how professionals think about risk during a trade. You have to understand that your risk-to-reward ratio isn't some static number you just set and forget. Oh no, it's alive, it's breathing, and it is constantly evolving.
And just as a quick little refresher, of course, your RR is simply what you're trying to make versus what you're willing to lose. You know, risking $100 to make $400. That's basic stuff. But the way that pros apply this concept, well, that's where the magic happens.
And this right here, this is pure psychology. The novice trader, when their trade is in profit, they are terrified, their heart is pounding, and they just want to grab that small win before it disappears. But when the trade is losing, they become the ultimate optimist, full of hope, just praying it'll turn around. The professional does the exact opposite. They are calm and hopeful when in profit, letting the winner do its thing. But when a trade is in the red, they're terrified. They cut it fast, no questions asked, because their idea was just proven wrong.
All right, let's make this real. Pop quiz. Say you took a trade risking 2% of your account to make 8%. That's a great 1 to 4 risk to reward, and the trade is a beauty. It's currently up 6%. So my question for you is, right here, right now, what's your RR? Think about it.
And here is the mind-bending answer. You are no longer risking your original 2%. That's history. You are now risking the 6% profit that the market gave you, all for the chance to make that final 2%. Your risk to reward has completely flipped on its head. It's evolved from a 1 to 4 to a 3 to 1. You're risking $3 to make 1. A pro sees that and immediately asks, is this trade still worth holding? That's what we mean by evolving R.
Okay, let's keep building on this. Our next advanced concept forces us to challenge one of the first rules every trader ever learns. It's a rule that, ironically, makes you the perfect target for those stop hunts we were just talking about. It's time to stop thinking about a fixed stop and start thinking about a rational one.
Come on, we've all heard this 1,000 times, right? It's like the first commandment of trading. And look, the spirit of the rule is good. You've got to protect yourself. But being super rigid with your stop can be a massive weakness in a market that is actively looking for those exact stop levels.
And I know this one is going to hit home. What do you do when this happens? Price dives down, that long scary wick comes out of nowhere, it kisses your stop loss to the exact tick, takes you out, and then immediately screams back up to your original profit target, leaving you behind. It's one of the most frustrating things in trading, and it happens because your safe stop was sitting in that obvious pool of liquidity.
So what's the pro move? Well, one really powerful technique is called the ATR trick. Instead of just picking a price, you look at the average true range of that big, aggressive sweep candle, the very candle designed to scare everyone out. Then, you place your stop that ATR distance away from the candle's low. See what you're doing? You're using the market's own aggression and volatility against it. This gives your trade room to breathe while still giving you a concrete invalidation point. It's a rational stop, not a rigid one.
Okay, so it's time to bring all these pieces together. Thinking about evolving R and using flexible stops doesn't mean you get to be sloppy. No way. In fact, it's the total opposite. Using advanced techniques like these means you need an even more disciplined, rock-solid plan before you ever think about clicking that mouse.
And a fantastic way to think about this plan is what I call the trading trident. It's a simple idea, but it's a super powerful mental checklist to make sure that every single trade you put on is a complete, well-reasoned business decision and not just a gut reaction to a squiggly line on a chart.
So the 3 prongs of the trident are your non-negotiables. First, your entry triggers. What specifically tells you to get in? Second, your invalidation level. This is your stop, maybe using that ATR trick we just talked about. It's the exact point where you say, I was wrong. And third, your defined target. You have to know where you're going so you can calculate your evolving R along the way. If one of these prongs is missing, you're not trading, you're gambling, period.
And that really brings us to the final critical question you have to ask yourself. Be honest. Are you just kind of clicking buttons and placing trades, hoping for the best? Or are you meticulously planning every move, understanding the market structure, and actively managing your risk like a business owner, like a professional? The answer to that question will, without a doubt, define your entire future as a trader.